If you're selling your business, leaving excess cash in the business is just leaving money on the table. What I'm going to do is go through how you should handle your excess cash to make sure you get your full value. This is part of a series of videos to help people that are new to selling businesses understand in layman terms the different principles and concepts that go with selling a business in a way that's easy to understand. The purpose being for you to help your advisors and have intelligent conversations with them and help you understand the process so you get the best result for your business sale. So first of all, let's start off with what is excess cash. Well, basically, in a nutshell, in a simplified nutshell, excess cash is the hard-earned profits that you've made in the past and should belong to you. You may have heard it explained in different ways that people will buy the cash in the business and that's part of the business and all that. And there are different thoughts on this. My thought is that if you have excess cash in the business, the reason it's there is that you've generated profits. The first thing to understand is, how does excess cash arrive? Well, first of all, we have to talk about working capital, unfortunately. Forgive me if you don't know what that term means. It simply is the short-term assets that go round and round that your business needs to operate. Generally, working capital is your cash, plus your debtors, plus your stock, minus your short-term creditors like trade creditors, minus like your payroll taxes and things like that, and VAT. And they all go round and round in a circle. And they act like one aggregate asset that allows your company to operate. What happens is, as you make profits, that working capital expands because you are now obviously selling more than you're paying for what you're selling for. Okay, so your cash goes up. What can cause working capital to go down is when you actually pay dividends. So now you have this excess working capital and then you pay that profit down as dividends. Also, if you buy capital equipment or you pay off loans, it can shrink it. But at some point when you come to sell the business, there's going to be a number of excess cash that is greater than the business actually needs to operate. So the business needs a certain amount of working capital so that it doesn't run out of money in the future. So that's really the way the layman's way to explain this, is you should be able to do a 12-month forward cash flow analysis and show whatever working capital you have in the business, however much cash is in the business now, that it's not going to run out at any time in the next 12 months. So a buyer is buying a working business that he doesn't have to add cash to later. Any amounts above that is surplus to operations and generally represents your profit that you should be able to extract. So that's what we call excess cash. It's really excess working capital that manifests as cash. Now, the thing is how to get that out. Well, the most basic way to get it out is before the sale transaction happens, you can declare a dividend. When you declare a dividend with whatever the excess cash is, that should bring the working capital down to what we call a normalized working capital level that the buyer will accept as enough left in the business for it to run. The problem with doing a dividend, of course, is that you attract dividend tax, which can be quite high depending on the amount. You can be up at 40% plus. Sometimes a very tax efficient way of getting money out of a business, particularly if you have a lot of excess cash, is to actually add the value of the excess cash to the sale price. And then on closing, that cash is paid back to you as part of the proceeds. So for example, if you're selling your business for £1 million and you have £200,000 of excess cash, we can write the deal for 1.2 million. And then on closing day, say they're going to give you a £600,000 closing payment against £1 million. They can give you the £600,000 that they were going to give you plus the £200,000 of your excess cash, so £800,000. And then what can happen is that you then pay capital gains tax, which, depending on your situation, generally the first $1 million, because of business asset disposal relief, is at 10% for each shareholder. Again, you'll need a tax advisor to validate all this for your specific situation. So this is just pointing you in the right direction, so to speak. But now you've only paid 10 or 20% tax on that excess cash instead of the dividend tax that you would have paid had you taken it out prior to sale. So it's a very, very opportune time to actually get money out of a business. We can do the same thing with director's loans. If you have director's loans that are in debit, meaning generally what happens during the year as you take money out of the business, it goes to a director's loan account. It looks as if you owe the company money, and then at the end of the year, your accountant actually turns that director's loan into a dividend. That's what's normally happening, and then you pay the correct taxes. What we are also able to do in many cases, again, subject to the buyer and the tax attorneys and the accountants involved, but what we can look at doing is actually in the same way adding the director's loan account to the top of the sale price and having it zeroed out. And there are several techniques for that, but it's the same effect of, rather than that director's loan account prior to the sale being switched to a dividend and paying that level of tax, you're actually ending up potentially paying capital gains tax. Again, I must emphasize you have to talk to a tax advisor in each specific situation because there are nuances, but this at least gives you a starting point to start asking questions. But it becomes very tax effective to get the money out that way. Generally, the buyer doesn't mind as long as it's all completely legal, because it's doing you a favor and making the deal more valuable for you, the seller. It also, in many cases, can increase the tax basis for the business, so that their capital gains tax, if they ever sell the business, is less because the value they paid for the business is higher. So it can be a win-win in many cases. So definitely something worth looking at. The other thing that can happen is that you have property or assets in the business. Let's say you use some of your profit to buy a Ferrari, and that's inside the business. Again, it's surplus to operations. It's not needed for the business to actually run. I always say businesses are like a sausage machine, and the sausage is profit. And what someone's really doing is buying your future sausage. If you look at the video we've done on business valuation, it explains how we come up with valuations. But in effect, they're buying that sausage machine. Well, the Ferrari is not part of what produces the sausage. The excess cash is not part of what produces the sausage. These are excess to requirements. And so again, if you had a Ferrari, you could take it with you because what it is really crystallized profit. You took your profit and crystallized it into a Ferrari. Property is a bit of a different animal sometimes. Sometimes we'll have properties in the business that are not relative to the business. You just bought a plot of land next to the business or in your local neighborhood as an investment. Same thing, you've crystallized your profit, and somehow you should take that with you. We can demerge properties into a different limited company to avoid stamp duty. Again, talk to the appropriate advisors on that, a lawyer, about demerging. If the property is needed in the business, then there's a couple different ways of handling it. One again is you can demerge it and charge rent back to the buyer for the company he's just bought. The only issue with that, of course, is the rent will lower the profitability of the business and potentially lower the valuation, but then you get a rental stream coming in. Another way of handling it is if property is not very valuable, it just becomes another asset in the business, like a machine or something like that that's needed. Say it's your office space or something that's only worth $50K or something. But there's different ways of handling that. The property gets a bit more complicated. But in the end, you've worked very hard. You've made this profit, and it's manifested in terms of generally excess cash. And in my opinion, it belongs to you. And we have an obligation as advisors to help you get your hard-earned profits out of the business, as well as get good value for your business. I hope this has been helpful. We designed this series to help people that are new to selling their businesses to understand some of the basics. If you want to know more, I've written a book called Selling Your Business. There's a link in the description field below to a free copy. I will also be happy to send you a paper copy. I wish you the best of luck in your business sale journey.